So this is going to prevent you from losing all the capital that you've raised for your deal, your private equity deal or your private equity fund before it's too late. So we've seen somebody go through an interesting issue, and you always want to, and so we might as well use this video to learn about how they've encountered this issue so that it prevents you from going through the same problem. And this will shave off, I guess it will prevent you from shaving off a few years of your lifespan being stressed last minute. So in a really small local private equity fund in this one was a private equity fund in Canada, and for this one what happened was people were very, like, the deal went through and everything at the end, but so people flaked on their commitments last minute. So because the problem of like people doing one-off syndications and things like that is people flake sometimes last minute, and so dealing with that process over and over again can be a bit annoying. So then a lot of people who have done, and a syndication, for those who don't know, it's basically in the grassroots English, using the equity capital of other people to use that money to buy houses, or types of real estate, in real plain English. So in one of those deals, they had something called a capital call, and they put that in place because they had like a lot of capital raised, and last minute when a deal was about to close, I think a few investors in the deal flaked and disappeared. And because they flaked and disappeared, they said, they came up with excuses last minute, and because of that, the deal needed to close, or else like the person's reputation was at stake, and the person would probably take years to have to rebuild that reputation of the other investors that already committed, and the actual deal that was selling, and it was just really a big mess. And there was a lot of flying back and forth to do due diligence on the deal, and it was sunk cost, so they had to make sure they got the thing done, and the guy's livelihood was depending on it. So what happened after this story? So then the way that it was dealt with was in the next deal that the person did, and the way that the person got the people is to have the investors put in a down payment, like a 10% deposit, to secure their spots for the amount of equity that they would want to raise. And when they put that down payment in, it will be non-refundable. So an investor would put in, let's say they wanted to buy like 1,000 shares priced at like 1,000. So basically they had to invest $1 million, for example. They would have to put like a 10% down payment, 10% of that $1 million in a down payment. And so they'll have to put like $100,000 in that case. So that really prevented investors from flaking last minute on their commitments, because they had some commitment built in. If you read the book Cialdini, Influence, it's one of the best books on influencing people ever. In that book, they talk about like the fact that if people take a small commitment towards an action, it can prevent last minute people dropping out. So that was put in place, so number one. And number two, for those who aren't aware, a capital call is just when you say, basically it's letting the investors know, the investors that are subscribed, saying, hey, we need this capital by this date. It's kind of like you're calling the capital call. Real simple, right? People like to make this stuff overcomplicated. So when that happened, and then, so that's number one. Number two is when you have the capital call, it's also good to raise more capital than you need. Because honestly, like, if somebody wants to really raise like 8 million, they should probably try to, like, based on their experience and so on, and all these factors that we talk about in other videos and other things, if they want to raise 8 million and then if they really want to raise 8 million minimum to survive, to get their things done, they would be advised to raise more than that. Attempt to probably like 30 million or like at least 3 times more than what they say what they actually need. Because the reality is that, especially in a recessionary, like a inflationary, they call it stagflation, but really like a recessionary environment, people are slower than usual even. So you want to just really emphasize and really go above what you think that you need. It's just like Grant Cardone 10X rule. You just want to go above what you think you need. You want to make the timelines tighter than what you think you need. You want to make everything better and greater than what you think you need, because it's going to default to something worse. And there's this quote, it's like, and I forgot who said it, but basically we don't rise to the standards of our goals, but we just fall to the minimum of our bare standards, right? So if your minimum standard is really lifted high, then it will be hard to default below that. And the point I'm making in practical terms, basically, you're reaching out to the investors and then they don't commit. You have a lot of investors that flake even after the capital call and even after the 10% down payments. Then what you can do is say that, hey, listen, investors, the ones that flake, they go off, but then you actually raise the minimum you need. So let's say you raise 25 million in commitments and you have all those deposits down. If those investors go away, then it doesn't hurt you because you've raised your minimum amounts. Albeit it won't be as nice as a press release because it'll be a smaller amount, but at least you don't actually make the maximum what you actually think you need. Like, let's say you need to raise 8 million, don't actually make that the offering maximum. Things rarely, very seldomly go exactly as you plan. So you want to raise more than what you think you need. So that's number 2. And I think that's really it. There doesn't have to be a third point for every video. So essentially, number 1, consider creating a situation where you have an investor obviously compliantly put a down payment for them to secure their spot in the equity deal, so that they have a small commitment that they've promised to make, and then they're just using the rest after their due diligence period to put in the rest of the capital. And that can reduce the risk of investors, falling out last minute. Number 2, to further prevent investors to fall out last minute, potentially consider, there are 3 points. Potentially consider to make it non-refundable. And make it non-refundable so then it's like they lose something. And then you work with obviously the securities lawyers and companies like Razors.com or different firms to make sure that it's compliant, and then you're good. Because the problem is that regulatory bodies are usually really biased favoring the investors. So you want to do it in a way that is obviously fair. So that's number 2. And I guess number 2.5 or 2B is you want to consider raising way more, like at least 3 times to 10 times more what you think you would need to raise. Because especially in a recessionary environment, at the time of the recording of this video, or in a skeptical environment, you want to consider the fact that people may flake, people may go back on their commitments, and you just want to account for that. You don't want to be one of those projects. There are a lot of projects out there that if they don't raise their targeted amounts, then they have to give all the investors back their capital and they won't be able to originate any deals. So you don't want to be in that situation. And you also don't want to be in a situation where you're telling everyone and putting press releases out that you raised like 10 million, and then really those are just commitments, but those aren't actually like capital that actually went into the escrow account and got wired. So with all those things, I hope that this puts you in the right direction. If you're somebody who's either maybe you're a sophisticated real estate or mergers and acquisitions person that's looking to get into the private equity fund world and have a team build that for you. Or maybe you're just somebody who's new to all this and then you don't even know what the basics are. Or maybe you're somebody who has done this multiple times and you've been in the business. But either way, it definitely is a reality that you always want to have that margin of error, and don't be over optimistic. Just have the margin of error in all facets and means to protect you. And even on the capital calls, you can put in like a little time, make it like a quick time delay and then timeline. It's like give them notice that, hey, we need this capital, like let's say in X amount of business days. And the shorter and tighter and more upfront you make everything, the better it'll be. If you say that, hey, listen, we're going to make the capital call, like we're going to make it a month notice, some people that will take 2 months to get back to you. If you make it 2 weeks notice, some people will take 1 month to get back to you. So everything is really, people are usually slower than what you tell them to do. Things are usually worse than what you expect them to be. So then not in terms of everything, but just in terms of trying to motivate people to take an action. So consider that, especially for even the small check investors, just consider that your equity sales process, you want to put in more work than you think you'll need, just so that if at worst case everything gets really bad, you've still met your minimum standard. And don't put your minimum standard as the max that you want to do. Put the minimum standard as one of the things that it's like it's your own corporate strategy. But always go out and raise 100 million and then get to 20 million, and then that's your minimum standard. Raise the 20 million, like say that you're raising 20 million, but then really your minimum standard is like 3 million. Don't put your minimum standard out there, because the minimum standard will always get eroded by the amount of work and amount of effort it takes to get the deals through the finish line. And with all these things, I hope this provides a little bit of clarity. And if you're somebody, you want to have a team build your private equity fund for you, and then you want to get out to market, head to raises.com. This is what we do. And one way or another, I trust that you're going to get in the right direction. So with this, I look forward to seeing you in another video.